Hey, welcome back to You Heard It from CFP. My name is Matthew Coyle, episode 73 of You Heard It from Minneapolis, Minnesota. I'm the Director of Financial Planning here at ACG in Minneapolis, Minnesota for Advanced Capital Group, otherwise known as ACG. Thanks for tuning in. Today we're talking about your retirement and spending your income in your retirement. Is there a right way and a wrong way to spend your retirement income? Spoiler alert, yes there is. Let's dive in. Yeah, looking pretty nice around Minneapolis these days with the fall colors starting to pop. Took some new drone footage. Not a bad time to be living in Minneapolis. Of course, the great white mist is about to descend on us pretty soon, but we'll enjoy these fall colors while we have them. All right, so let's look at an example to talk about what is the right way or the wrong way. And maybe there's not always just one right way or wrong way, but there's certainly better ways to distribute your assets from your financial assets that you have when you hit retirement in a way that makes more sense to minimize your costs and maximize the longevity of your saved base, right? Because everybody wants to accumulate things, but then they forget how to distribute them in a way that makes sense. And then you get into, do you need annuities or do you not need annuities? Do you need insurance products? Do you not need insurance products? All things we can talk about in other videos as well. But today we're going to talk about the spending order and how much the spending order makes a difference when you are at the distribution, or what some people call the decumulation phase of your retirement plan. So let's look at a theoretical family, and this is actually kind of theoretical. This is actually a real family, but their name's been changed. I call them the McDucks, but this is just your basic kind of everyday married couple with a couple of kids. They are in their 50s or 60s, and they're looking to get some ideas on how to distribute their assets when it comes time to do that, so they don't pay too much tax and that their assets last a little bit longer. So let's take a look, and we will talk about the right way and the wrong way to spend your retirement income. Okay, let's meet John and Jane, our theoretical couple. Now, again, they're only theoretical in name. They are a real couple. They actually live in the state of Iowa. They have a couple pensions between them that are modest in size. They have a couple 401ks that are between them, one for him, one for her. A couple of taxable accounts and a Roth IRA for him. So the question they posed to me was, how do we spend these assets in a way that makes sense, that makes them last as long as we possibly can, and minimize taxes along the way, right? Simple assignment. Relatively straightforward question, but of course very valuable. Let's take a look at the assets first. A couple of 401ks. We have a $350,000 401k, a 4.25 401k, a couple taxable accounts, and a Roth IRA. So they've done a nice job of saving here. 1.6 million. It certainly doesn't put them in the top 1% of savers, but they've done a very, very nice job. It's not a princely sum, but it's certainly an asset base that will be able to support them in their spending need going forward. Very specifically, they wanted to spend $90,000 a year post-taxes with some other goals factored in. And we're going to look at how to spend that and minimize tax and maximize the longevity of the asset along the way. Okay, so let's look at that. Okay, so first thing we're going to do is we're going to run what's called a Monte Carlo simulation on these assets. Now, without going into too many details about what that is, basically it's a calculation that calculates in the aggregate, do they have enough to meet their goals? Now, depending on how you run the numbers, yes, they have. Now, we run the numbers several different ways. We ran it for them several different ways. And we came upon two different scenarios. Both have either a 99 or 97% odds of funding everything they want to fund. But in the aggregate, that doesn't really tell us a lot. It tells us they have enough money, but it doesn't tell us what order they need to spend that money in to make the funds last as long as possible. Now, you would assume that the 99% one or option has a better chance, but we don't really know that unless we dig into the numbers, change the spending order, and then calculate the taxes and such to figure out what the odds are and what the total is over time spent on taxes, things like that. So when you do that, you find a couple interesting things. We're going to start by assuming we spend the tax-free assets first. Okay, tax-free assets would be things like Roth IRAs and taxable accounts, right? Because this couple has taxable accounts and Roth IRAs. Now, most likely you can kind of pick at your cost basis. You can find certain investments or items in your taxable accounts you can pick off first, or you can even borrow against them too if you wanted to. But in this first example, we're going to do tax-free assets first. We're going to spend those first, and then we're going to do the taxable assets last. Okay. In example 2, we're going to look at the tax-free assets last. Okay, so example 1, we're doing the tax-free assets first. In example 2, we're going to do the tax-free assets last. Okay, we're going to change the order and see how that affects our total taxes owed. Now, in each example, I'm just keeping it the same. They live in the state of Iowa, so I'm using federal and state of Iowa taxes. I'm assuming a post-tax spend of about $90,000 a year. Okay, so the total money they're spending throughout their life is about, in retirement, is about 3.36 something million, right? It's not, that's not changing between the two, but how we get charged for that, the taxes we pay on that, is going to be different based on the order of which we draw from these accounts. Okay, spending the tax-free assets first versus spending the tax-free assets last. Now, again, as a reminder, tax-free assets are things like Roth IRAs, taxable accounts, anything with like a brokerage account to it, something like that. So if you spend the tax-free assets first versus last, I'll just give you the net difference. We'll talk about why that is happening. When you spend the tax-free assets first versus last, you actually will pay $328,763. And again, this is a projection. $328,000 and some change more in taxes over the lifetime of the retirement than you will if you spend the tax-free assets last. Now, why is that happening? Well, the reason is down to how they compound. If you remember how they compound an IRA or a rollover IRA or a 401k or some tax-deferred asset, will actually compound on a tax-deferred basis, meaning the IRA or whatever the account is growing, but what is also growing alongside of it is the tax you will owe in those withdrawals in the future, because as the withdrawal increases, so will the tax, assuming the tax stays the same, right? If you take the tax-free assets last and let those compound over time, you can get to a point in your life where you're spending more and you're withdrawing more from those accounts, but you're not owing any tax on them because the tax is not compounding along with the account, because they are tax-free assets, or at least mostly tax-free assets. In this case, again, it's $328,763 more by spending the tax-free assets first versus last. So it makes a big difference on how you withdraw. And a lot of times when you focus on just the aggregate level, that's great that they have enough money, but you need to be able to fine tune and kind of figure out what assets to spend first. And this is where a value of a planner can come in quite handy, because they can help you run these scenarios. They can help you look at your assets, the cost bases, reduction strategies, all these types of things, and look at the withdrawals and figure out, when should I be withdrawing? What assets should I be taking first? What assets should I be taking last? So $328,000 more by taking the tax-free assets first in taxes owed. If you were to do that, obviously that is where the planner can come in quite helpful to determine that cost. Okay, some final thoughts and takeaways. Number one, if you have all of your assets in one type of account, let's say it's all in an IRA or it's all in a 401k or it's all in tax-deferred assets of some kind, right? Then it's really not going to matter so much how you draw the assets, because if they're all coming from one source anyway, well, they're all going to be taxed the same and the difference might not matter. But most people these days do have assets scattered in different types of accounts, right? Taxables, Roth IRAs, 401ks, 403bs, insurance assets, whatever. There's a whole bunch of different asset classifications these days, way more than when I started in this business 23 years ago. But if you have everything scattered, it would definitely benefit you to go speak with a planner, whether it's us or anybody else, and project out how those assets might be treated in the future and how much you're going to spend and what might be a good draw order for you to do. That's number one. Number two, if all you have is tax-deferred assets, you may want to consider adding a Roth IRA to your equation, to your asset base right now, to kind of even out that equation of how much you're going to spend in the future. You may even want to consider doing a Roth conversion of some existing assets that you have in IRAs or what have you. And that may or may not be worth it depending on your time frame. Talk to us if you have any questions. Of course, my information is always at the end of this video, but there are a couple of takeaways for you might want to consider, but it does matter how you withdraw these assets and how you utilize your resources so that they grow. One thing I didn't mention in those first few little video clips there is the end balance at the end of this whole thing. What if you spend the tax-free assets first or last? It can mean anywhere from $500,000 or $1 million in ending balance left at the end of your plan, okay? I'm going to say that again because it's really critical. How you withdraw these assets not only affects the taxes that you pay, but it also affects your end balances when you are planning on being deceased, or when your end of plan happens, which is a nice way of saying death. If you plan on leaving some assets for your kids or for some heirs or even for some charities, you may want to consider utilizing your tax-free assets last, not first, so that you have more to leave to them in the end after you're done spending it. So that's another thing to consider too when you are planning on how you draw down your assets. It makes a big, big difference. So I hope you got something out of this. Thank you again for being here. Thanks for watching. Time is your most valuable asset, as I always say. Please spend yours wisely. If you have any questions, reach out to me. My information is right there. And again, I thank you for coming, and you have a very nice day. I'll see you next time. Bye-bye.